welcome to PWM. Today we'll talk about the latest trends and developments in the ETF space, and we'll discuss the new and more dynamic ETF strategies that are used in private client portfolios. The PWM team has traveled to Geneva, and I'm joined today by prominent figures in the assets, wealth management and the private banking space. Thank you all for joining me. In this first section, we will explore the impact of the late market cycle on the demand for more dynamic ETF strategies. In particular, we look at the growth of smart beta, so non-market cap weighted index ETFs, and the rise of multi-factor strategies. And we'll also analyze some of the issues and that generally surround these new products.
My main concern is that the ETF is a quite useful vehicle to implement many style of strategies, but the biggest issue for an ETF, it's a long-only, for 95% of strategies, long-only products. Meaning that when you have a bull market or a trendy market during 10 years, it's a very useful and powerful instrument, but at one time, it's not if, but when we will have a corrections, perhaps it's not the best products to own standalone. Meaning that's why we have more and more alternative strategies, multi-factor strategies.
Well, I think ETFs have proven a very efficient structure for investors to gain access to various factors. And I think this makes the combination of smart beta and ETFs so interesting and so efficient, because it's like Jacques said, it's a liquid tool.
And you see that there is these market conditions may drive a higher growth of demand for smart ETFs.
Well, I think it depends on the market, on where we are in the cycle, but there are certain strategies on the smart beta side which are maybe a bit more conservative, a bit risk off. So if we go into a more volatile environment, if we come into a more bumpy road, you know, certain investors shift from core equity exposures to potentially more conservative smart beta products, but still being invested in the equity market. I think this is the key. Yeah.
If we look at historically, late cycle environments deliver high returns with more volatility. What are private clients looking? They want to be invested, but want to hedge. And that's actually our CIO view right now, is stay invested, but hedge. So in principle, you would assume that smart beta ETFs would follow in terms of a hedging, so low volatility, market neutral factors, these type of things. But I think from a private investor perspective, not from a professional investor, I don't think the clients are going to flock to it the way they've done with the long beta theme. And the reason really is education. These are very complex algorithms behind them are complex. So the question is, how do we get our clients educated enough to understand that they potentially can and should use smart beta ETFs? The fantastic track records that we always see simulated say yes, but the evidence is not there yet. And I think it would be interesting to see what's going to happen, because they're not tested. You know, we've been in a bull market, so we haven't really tested them yet.
And what do you think, Christophe, is the main driver for smart ETFs? Is it disappointment with actively managed funds, would you say, or?
I think it's one of the reasons. The first one, as said before, is that we have been in a bull market with limited volatility that drive mechanically the flows to this kind of investment. But it's true that also you have a lot of academical research and comment around disappointing performances from active managers that has been also very helpful for ETF sponsors as a strong argument to promote their offer. But it's also, third reason is maybe that ETF, and especially smart beta or smart factors, are an additional tools in the toolbox of portfolio manager. They should not oppose these tools to active fund manager. They are a complement that help you to navigate and get quick and transparent access to certain thematics or factors that can be put in or out of the portfolio very easily. I think that's one of the main reasons. Another one is maybe the ability of ETF sponsor to catch up some strong thematics in the market. For example, when we had the ECB QE, the ability to launch ETF on peripheral debt very rapidly has been a success factor in the motivation of portfolio manager to adopt this kind of instruments. So this kind of semi-active ETF is a great way, if you do properly the due diligence on the index methodology, to get exposure to this thematic you want to implement.
And actually, income-seeking strategies represent the bulk of assets in smart ETFs. 5 of the 10 largest strategic beta ETFs in Europe follow a dividend-oriented benchmark. One problem with dividend-oriented passive funds is that many of the benchmarks they track do not apply income sustainability filters. So, Bernard, can you explain why it's important to focus on quality income?
Because what you want to avoid is investing in an index that captures stocks that might pay a dividend 1 year, but the next year there's no dividend. So this stability, this stable dividend growth is really crucial. And one solution is the Dividend Aristocrat series, which provides you with an index methodology that makes sure you have only eligible stocks in the index that have a very long-term dividend growth. For example, Dividend Aristocrats, the methodology for the US market, stock is only eligible once it has 20 years increasing dividends. So this is really very stable. And the European version is still 10 years. So you avoid those one-time great dividend stocks and then disappear again. Back again to the discussion around really looking into the index methodology. And smart beta is not smart beta.
All these ETFs are relatively new.
Yes.
They are less than 15 years old. So it creates new opportunities and new challenges for portfolio manager. It brings you back to the old challenge of portfolio construction with additional tools. But then you have to be very disciplined with your investment process to be clear on which factor to favor at which stage of the cycle. So then you have to have the proper methodology in place to know where you want to go first. Then you have plenty of choice in the market. I think that just for the value styles, you have more than 60 different ETFs with relatively similar methodology, but relatively different also.
As a private bank, we have to rethink how we're looking at selecting ETFs. And I think that's a very key component with smart beta, because you can't use the typical selection criteria you would normally use for a regular core, long, only beta ETF. There, it's almost like doing a due diligence on a CTA or a managed futures manager. It's a very quantitatively focused due diligence aspect, and that adds, from a wealth management perspective, that adds another layer. I don't want to use the word complexity because it's not complex. We have that internal. But imagine trying to tell the alternatives due diligence analyst that now they're going to be looking at ETFs. There's a mindset change that has to occur also with smart beta. So there's a mindset change to the criteria, the selection criteria, as risk managers on behalf of our clients.
And I think also things become more complicated with multi-factor strategies. I mean, we know that there is academic research that suggests that individual factors tend to outperform the market over the long term, but they can go through long spells of underperformance.
Exactly.
So by combining factors, multi-factor ETFs or funds aim to smooth out the ride. So is the reduction of volatility or risk the main reason for investing in multi-factor ETFs? Maybe Jacques, you can come in. Do you think it's, I mean, why do you use just single-factor ETFs?
Why? Because it's, I think for me, it's just the transparency is key. It's just I don't want to buy a black box. Even if it's smart beta is sometimes not smart at all. This is the issue. And we have the right as a risk manager, as you mentioned previously, that, and Christophe just pointed out the right stuff. We have to pay attention on to work hours on the index methodology. On single factor is quite obvious, I should say, and it's very simple. In multi-factor is quite complicated and challenging, and sometimes the methodology could change during the time also, on the speed to adapt the process, investment process sometimes could change too. That's why it's for me it's passive instrument. It's a fantastic instrument, but if we use this to play active, it's not the same world.
But then you need to, is it possible, do you think, to time the factors? Isn't it that difficult as timing the market?
No, it's all depends the approach. I am a global macro guy. When you have a global macro top-down approach, it's quite very useful to look at in which cycle you are in the economy. After Trump arrived with fiscal easing and so on, okay, boom. This is getting traction on growth stuff, boom, we are playing growth stuff or small caps, for example. Or when you have some kind of quantitative tools behind you, you can put some models with GDP, PMI, or ISM, all these kind of metrics. And after you can quantify, I should say, some process too.
Every year we have 30 to 40 new factors discovered, promoted by ETF sponsor. So again, it's a new challenge to already be able to navigate around single factors.
And do you think, maybe Felix, that terminology may also be an issue, that people do not understand what smart means?
Well, smart beta is the whole range, right? But it's also a bit an unclear term. It's a marketing term. When you invest, whether you're an individual investor or institutional investor, you need to understand what you're doing. Mm-hmm. And just looking at the label and say, oh, okay, that's the label smart, I think that would not be smart. I think, as an investor, it comes down to a trade-off. How much flexibility do you want and how much do you want to pay for this? Because already now, we have nice ETFs, very, very cost efficient, and can allocate to Swiss equities, for instance, or to, I don't know, mid-term duration Swiss bonds or high-yield US bonds. You have all these ETFs. Now, in an ideal world, you would say, I want to have exposure to, I don't know, European equities or Swiss equities, just that factor, and maybe just small cap, and then the value factor, right? And then I can have all these very, very tiny building blocks, and that gives me full flexibility. But that world would come at a cost. And as an investor, I have to make this trade-off. How much flexibility do I want, and how much would I pay for this?
That's great. Thank you very much. Thank you.